This is Sid Haas with LKCS. I'm the Vice President of Business Development here. And again, I want to thank you for joining our webinar today on credit-based marketing and how we can help you use and leverage credit data to generate loan growth. For those of you not familiar with our company, I'll just give you a very short background. We've been working with financial institutions nationwide since the early 1960s. We provide a wide variety of services, all targeted and designed specifically for financial institutions. These range across all different types of channels, marketing channels, both traditional and electronic marketing channels, as well as our statements and e-statements. We view those as just kind of an outcropping of marketing channels as well. And you'll see today that we actually leverage this credit data across all of those different channels to help you, really leverage the power of that credit data. So when we talk about credit bureau data, we are talking about actually purchasing data from the three major credit bureaus, Equifax, Experian, and TransUnion. And we have relationships with all three, which is pretty important because not all of the credit bureaus have information on all of the people, on everyone. So it is important to source data from multiple bureaus, and there is no additional cost to do that. So, there's no increase in cost for you to actually query data from multiple bureaus at the same time. And what that results in is actually up to a 70% increase in leads when pulling data from three credit bureaus as opposed to, one or two of them. So that's very important to note. We actually supplement this credit data with data from other sources as well. So we'll discuss how we can, search within the credit data, but we can also search for demographic information, for homeowner information sourced from county assessors' offices nationwide, all sorts of automotive purchase information, and then a lot of different model information. So AVM models, when it comes to home values, and even behavioral models, and things like that. There's also credit triggers, which we'll talk about briefly as well. So lots of different data points, lots of additional information that we can use to really hone in on the appropriate target market for your marketing campaigns. But what we're really talking about, the primary focus of today's webinar is on credit prospecting, is what we call it. And what we're able to do is with these pre-screen marketing campaigns, they're applicable for you to market any type of loan product. So, very applicable to auto loans, mortgages, any type of home equity product, certainly auto and mortgage refinancing, credit cards, student loans, personal and unsecured loans, but all sorts of other types of loans as well. We have the ability to pre-screen either your existing account holders or prospective account holders, in the markets that you serve. So we don't necessarily need to only look at your existing members and customers, but we can look at prospective, people as well. So what we're doing with credit prospecting is we're extending pre-approved or pre-qualified offers of credit, to these people based on actual credit score and credit history information. And you have the ability to set these credit criteria to identify the people that will qualify for a loan based on your specific underwriting requirements. And then, you can send direct mail offers, email offers, statement-based campaigns, or even make outbound phone calls to the people that meet, these criteria. So I'll show you several examples of ways that you can use these. And these are just examples. So, we can get very creative and, and based on what type of loan product you are looking to promote, we can help you really identify the different parameters, the different credit parameters and demographic parameters and psychographic parameters that would be most appropriate for your campaign. But to start getting you thinking about ways that you can use this data, I'll show you a few examples, and know that these are just examples so you can adjust these as needed. Obviously, you can adjust the credit parameters to fit your lending guidelines. We can add or remove criteria to any of these campaigns, but these are just ideas. So very common for us are all sorts of auto refi campaigns. We execute these all the time, for customers. Very common scenario is actually on the right-hand side of this slide, where we look at, loan payoffs. So we look at people with, FICO scores, in this case, above 640. We would exclude anybody with a history of, late payments or repossessions, potentially. We could exclude bankruptcies, include bankruptcies, whatever, whatever your underwriting criteria are. But we might look specifically for people with 2 to 3 years left on their loan, or look at people with a specific minimum balance remaining on their loan. And then we can actually calculate based on their credit score and, obviously remaining term of their existing loan, we could calculate what rate they would qualify for at your institution, and then compare that with what their current payment is and identify what their potential payment savings would be by refinancing that loan with you. And then say, if they're going to save at least $20 a month, then we want to send an offer to them. And so we can identify that payment savings as part of the pre-screen and then actually show that on the offer. And I'll show you examples of what that looks like. But another potential campaign that you can consider is leases are becoming more and more popular, especially with, younger demographics. So we could look at, again, the same people with FICO scores of 640 and up and exclude those same derogatories. But in this case, maybe we're going to look at people with, 3 months or, even 6 months left on their lease. We know when that lease comes due that these people are most likely going to be, doing something for a vehicle. They're going to be purchasing the vehicle they leased, they're going to be leasing another vehicle, or they're going to be looking to finance, and purchase a different vehicle. So now's the opportunity to let them know that they've been pre-qualified, pre-screened, pre-selected for a loan with your institution, and here's reasons why a lease may not be the best choice, for their next car or truck. We don't necessarily need to limit, obviously, our auto campaigns to people with existing auto loans either. We can pre-screen people or pre-qualify people for their next auto purchase. So we can do just a general loan pre-approval type of campaign. Again, looking at, FICO score 640 plus, and obviously you can adjust this to whatever, you need. Some people, some of our customers go lower than 640, some go higher, excluding those, whatever derogatories you need to exclude. But we could look at potentially people that have no more than 1 auto loan in the household or 0 auto loans in their household, and they haven't opened an auto loan in at least the last 24 months, as an example. They meet these criteria, and then we can go ahead and let them know that they're pre-qualified for an auto loan with this institution. And, here's the rates they would qualify for, or here's the payment, here are the different payments, for different loan amounts, all sorts of different ways that we could show these offers. We can personalize these campaigns, again, with other types of data. So to give you an idea, we have a couple of different models, again, in our arsenal, such as what we call a vehicle lifestyle indicator. This tells us potentially what type of vehicle a prospect might be interested in. So we can customize the offer with a photo of, a male or female, knowing the gender of the person we're sending the offer to, of the appropriate age group, because we'll know the age of the person that we're sending the offer to, in the appropriate style of vehicle. So we'll know if somebody's, if their lifestyle fits them purchasing a sports car or a minivan or a luxury sedan or whatever it might be. If this type of indicator is wrong, we're not going to offend anybody. But if it's right, we're going to make that mail piece just that more relevant to the recipient. As one example of how we can customize, these campaigns and these mail pieces, for maximum effect. We also have the ability to include what's known as an auto response insight. And this is just a model that indicates the likelihood that somebody will respond to an offer, to an auto offer. So again, it's a model, it's a behavioral model. So it's generated by the credit bureaus. They don't exactly explain their secret sauce, but it most likely has to do with how often these individuals, have entered the market for an auto loan. And, if they're due for their next one, that score probably goes up, higher for that particular individual. So there's different ways they compute these scores, but it's a numeric scale. So we can look at the top half or the top third or the top 10% even, depending on how, large of an area or large your, potential account holder database is, to again hone in on the best list, and the best for the best possible response. We obviously can use these campaigns for mortgage refinances. Rates are going up. Everybody realizes that, but it's still amazing to me how many people we look at that haven't refinanced their home in the last several years. So when we look at mortgage refinance campaigns, we have that same opportunity to look at FICO scores, in this case of 680 to 720 or 680 to 750. Looking at mortgage balances of at least $100,000. We can exclude anybody with FHA or VA or reverse mortgages. And we can look at the age of the loan. So we can make sure that nobody's refinanced recently. We can, do all sorts of, different calculations in there, even look at potential payment savings, just like we did on the auto loan side, and even look at LTVs. And again, depending on what your max LTV is, obviously higher people with higher LTVs are more likely to respond. So there's different opportunities for us there on the mortgage refi side. And then we're still seeing a lot of home equity refis. So these are people with lower mortgage balances and lower LTVs, but they're actually refinancing their first mortgages with a home equity loan in the first position. So if you're looking to put some mortgages maybe on your books instead of selling, first mortgages, this may be an opportunity to discuss. Credit card campaigns, just to give you an idea, we do a lot of balance transfer campaigns. Again, looking at FICO scores, we can look at people's existing credit card balances, existing credit card debt. We can further qualify them by looking at their credit card balance to credit card ratio, so we can make sure that they're not maxing out all of the credit cards that they have in their wallet, because that's not necessarily a good thing, right? And again, exclude, people with those 30-day lates. Exclude people with 30-day lates, or maybe let them have one 30-day late in the last 12 months, whatever you're comfortable with. Exclude those bankruptcies, make sure nobody has any collections. Again, just give you ideas of all of the different credit parameters that are out there. There's literally hundreds of different credit fields, and we can go through these with you and help you really determine which ones you want to look at. What's important to note is these are pre-screened criteria, so you don't want to use too many criteria to limit your audience too far. All of these people, and we'll discuss this again, but all of these people still have to go through your complete application process. So we're just kind of pre-screening to identify the people that are most likely to be approved for your loan. Even if we're telling them they're pre-approved, they still have to go through your full application process. And we'll discuss that again in more detail. So we actually have the ability to combine multiple offers, again, for maximum response. So, LKCS, one of the things that we're really known for is this target marketing. And we want to make sure that the campaigns that we send out are really designed to be relevant to the individual that we're sending it to. And the more relevant it can be, the more personalized the offer to each person, the higher the response rate, our clients are going to receive. So to give you an idea what that looks like is we can layer different offers to the same audience so that, the different people that receive different offers, but those offers are, highly personalized to them. So as the first example, we can look at first-time home buyers. So we can identify renters, right, and qualify them by all those different credit parameters, and we can explain to them that they're pre-qualified for a mortgage, and here's why it's a good time to buy instead of rent. Obviously rates are going up. The longer you wait, the more you're going to pay, et cetera, et cetera, et cetera right now. We can then send out to a different group of, customers or prospects your revolving debt reduction offer. So now instead of renters, I'm going to be looking at homeowners. I'm going to be looking at homeowners with a specific amount of available equity. Maybe I'm going to be looking at people with available equity over $50,000, but they've got revolving debt over, say, $20,000. So they're carrying a bunch of credit card debt. So I'm going to send them a home equity loan offer, but I'm going to obviously discuss how we can use that home equity to reduce their debt and ease their budget and do all those things and the terrific benefits that that's going to provide for them. And I'm going to qualify these people specifically, again, by their FICO score and other credit parameters. I'm not going to send this to everybody. I'm going to only send it to those people that meet your underwriting guidelines. And then I'm going to look at the same group of homeowners, maybe with that same $50,000 in equity, but these are the people that aren't carrying that $20,000 in debt. Maybe there's other criteria that I'm looking for. Maybe they've got college age or high school age children, so I can talk about how we can use home equity for other purposes like education funding, or I can look at how long they've been in their home, and I can look, talk about using home equity for home improvement and, different options for using home equity, but again, making the message relevant, more relevant to that recipient to drive up those response rates. At the end of the day, these two campaigns result in the exact same product and the same, opportunity, I guess, for your institution. The goal is the same, to generate home equity loans, but the message is totally different to the people that we're sending it to. But that message is, again, just more relevant to those and personalized to those recipients. And that's very important to note. It's not just a general home equity offer, which we certainly could send, but by using the information that we know about the individual, I can drive up the response. So to give you an idea what some campaigns can look like, I'll show you some actual campaigns as well, but these are just samples. This is what that first-time home buyers campaign could look like, is some kind of direct mail or like a self-mailer or a postcard. And we'll talk about this further, but you'll actually see that there are some disclosures that are going to be required on these mail pieces. There's actually two different disclosures that are required by the credit bureaus that identify that you have used credit data in these campaigns, and how these people can opt out of receiving these types of campaigns, which is all managed by the bureaus directly. This is how we can actually use these as letters. This is very, very common. We'll send these out as letters, and we actually use these as what we call statement cover letters. So for those of you that are statement customers of ours, we actually process and mail statements for about 200 financial institutions each month. We can actually include these as the first page of your statements or e-statements. So we'll identify your statement recipients that meet your pre-screen criteria for these campaigns, and then print these letters as the first page of your statements. So these are what these letters could look like. Obviously, these are not templates. These are all custom designed for each of our customers, but these are just, generic kind of samples that I'm showing you just to give you an idea. And these can also be sent by email. So the credit bureaus are absolutely, totally fine with you sending out emails with these offers. It's the least expensive way to send these campaigns, and it's also the most measurable. For those of you that are not used to sending email, obviously email is highly trackable. So we can see not only, how many emails you sent, but how many have been read, how many have been clicked, how many links have been clicked within those emails, who's read the messages, who's clicked on those links. And then by looking at that information, your loan officers can then use that to make follow-up phone calls to those people who have clicked on the messages, or you can use that to send further follow-up emails potentially. So you're just further qualifying those leads. And we'll very often use emails and letters in conjunction with each other. So we'll send a letter out and follow it up with an email, or even the other way around, we'll send an email first and follow it up with a letter. Lots of different strategies that we can employ. So we're also using this in conjunction now even with online advertising. So we'll send out a letter and then use retargeting ads. So we'll drive people to landing pages and then use retargeting ads, for those of you familiar with that concept, to drive people back to the website. So similar to if you are shopping at Amazon, looking at a pair of shoes or a fishing pole, and all of a sudden that pair of shoes or that fishing pole starts following you around the internet. Well, your home equity loan offer or your auto loan offer could do the same thing. Follow your qualified loan prospects around until they come back to your website. So just to give you some ideas of what clients of ours are actually doing, these are some actual loan campaigns, what the real letters, I guess, look like. So on the left, this is a loan recapture campaign. Might be a little bit small on your screen, but what you're seeing here is we're actually printing the estimated loan balance, the estimated current payment, and the estimated new payment for each loan recipient. So this is how we can identify those payment savings that I was talking about. We're only sending these letters to people that we can save at least $25 a month, so they can see how much they're saving on their loan. And we'll show them obviously what the rate and term is and amount of that loan in the body of the letter as well. This same customer also sends out a Visa offer to qualified prospects. These go to different people. They don't get the same offer, but they actually send these campaigns monthly. So these do very, very well for them. This customer sends out an auto refi campaign regularly. Same type of concept, just a different way of approaching it. They send both postcards and letters in different formats. Same type of thing, we're calculating payment savings for them. So they'll show different payment savings calculations in different ways on the letters or postcards. They'll also drive people to a dedicated landing page that also, potentially triggers that retargeted advertising that I had talked about. And then some additional winners. These guys do these campaigns regularly as well. This is another Visa type credit card campaign. This isn't computing a specific payment savings, but they're actually showing their rate compared to rates of just some other, kind of average bank rates, out there, and possibly using balance information for each recipient and just calculating what the potential savings would be with a generic rate as opposed to their rate. So they're using the actual balance, the outstanding balance of the recipient and the rate they would qualify for on their card, but not the actual credit card rate information, just using kind of a generic rate that's out there. And this was an unsecured loan campaign that these guys run regularly that's just done outstanding for them. It's personalized as far as the unsecured loan amount. These guys are really targeting payday lenders with this campaign. So they have specific criteria that we're looking at to identify members of theirs that may have fallen prey to some payday lenders, but they've seen huge results from this type of campaign. I'm just listing rates, so they're not showing potential payment savings or anything like that. Just a very simply worded campaign. They follow this one up with an email about a week or two after the letters go out, and it does extremely well for them every time they send it. So whenever we use credit data, there are some requirements, so I can go through those. Like I've said, you have the ability to specify your lending criteria, so your lending guidelines. So you don't have to use any of the guidelines that I have shown you or any of that. These are definitely your guidelines for whatever type of loan you're sending out. And, we can certainly support risk-based lending and all of those types of strategies with any of these campaigns. But the one thing that's important to note is that you do have to send what's known as a firm offer of credit. So we can't send the type of campaign that's known as an invitation to apply. We can't just say, hey, we have great auto loans. Have you heard about them? Why don't you come in and apply, or here's how to apply online. We have to have more specific information about a loan offer to be compliant with the Fair Credit Reporting Act. And we help with all of that. So what that means is that when we're using the credit bureau data, your offers, your marketing materials must include language that the person receiving the offer is pre-selected, pre-screened, pre-qualified, or pre-approved for a specific type of loan. We have to tell them what type of loan they're approved for. We have to tell them what the minimum amount is that they're approved for, what the rate is, that they're approved for, at least what the maximum rate is, and things like that. So these can be different sizes. They don't necessarily have to be in large print. In all cases, we can put them in the fine print on the back side, but there's definite elements that have to be included in these offers. We have to have specific terms and conditions, your terms and conditions, what makes these people eligible for these loans, and include even why credit may not be extended after all. So if they don't have the income to support repayment, or they don't have the collateral, those types of things. Because again, just because we're telling somebody that they're pre-approved for a loan, they have to go through your complete application process. And if anything indicates that you would not normally approve them for a loan, you're under no obligation to still fund that loan because you've told them they're pre-approved. And then there are specific opt-out notice and disclosures that need to be included, from the credit bureaus. So there's 2 box disclosures, typically one on the front and one on the back side of your letters. If it's an email, then obviously there's one above the other that have to appear from the credit bureaus as well, that indicate that credit bureau data was used, as part of the campaign, and here's how to opt out of those campaigns by either calling an 800 number or visiting a website run by the credit bureaus. So what's the cost of credit prospecting? Well, pricing depends on a few factors, but the biggest factor is really the number of records that you purchase. In other words, the number of people that meet your criteria, and then how many mail pieces you're going to send. So you may find that, say, 10,000 people meet your criteria, but then you're only going to send out 5,000 mail pieces, so you would buy 5,000 records in that case. There can be a slight variation in the cost based on the different demographic fields, but that's pretty rare. So really what you can assume as an estimate is that the cost is going to be about 25 cents per record. It is a really good figure, at least from LKCS. And there are credit bureau minimum charges. So just know that if you purchase the data directly from the credit bureaus, they're going to have minimums, and we have minimums as well. So we buy a lot of this credit data. So we've negotiated low minimums with the credit bureaus, and we've actually negotiated what we call like a calendar month minimum. So within a given calendar month that you purchase data from the credit bureaus, you're going to have to purchase at least $750 worth of data. Now, that's not a campaign minimum, so let me explain that. We can run multiple campaigns for you, or at least purchase data for multiple campaigns within a given calendar month. And together, the cost of the data for those campaigns can be used to fulfill that $750 minimum. So you can run a couple of different smaller campaigns to meet that minimum cost. You don't have to spend $750 potentially on one campaign. That's not a high number. $750 at 25 cents per record is only 3,000 records, so it's not a huge quantity to begin with. But when we talked about things like that lease expiration, for example, those types of campaigns typically result in only a few hundred records for some of our customers. So they would be cost prohibitive, in some cases, if you had to spend $750 for that data alone. But if you were to combine that with a more traditional auto loan recapture campaign or some type of other credit prospecting campaign, then obviously you can afford to do it at the same time, and off you go. We can always run counts and estimates for you. So if you're just curious as to know how many people in your market or how many of your account holders meet certain criteria for a campaign, give me a call, shoot me an email. We can talk about it. I can run the counts, and I can let you know how big that universe is, right? How many people are out there that meet that criteria, and we can discuss the best strategy to launch these campaigns. And what we like to see is obviously that there's plenty of people meeting the criteria, more than you would ever want to necessarily mail to, so that you could continue to see how successful it is, and then continue to run these campaigns, target, narrow down that those criteria to a really targeted level that's going to maximize that return, and then potentially loosen it up as you really see the effectiveness. But we can discuss that on an individual basis. Another option is what we call credit alerting. So the difference between credit prospecting, which we've talked about for most of this presentation, and credit alerting is the following. Credit prospecting uses credit data, what I call proactively, meaning that we're reaching out to people based on specific demographic and credit traits that we see, and we're guessing that they might be good loan prospects. Credit alerting uses the credit data kind of reactively, and I don't mean that in a negative sense at all. But what we're doing with credit alerting is we're marketing to people that are actively seeking a loan somewhere else. They didn't come to us first. What happens with credit alerting is we're receiving daily alerts from the credit bureaus on hard credit inquiries for your members and your customers or prospects that live in your markets that applied for a loan with another institution that meet your specified credit criteria. So when one of these people, when one of your customers or a prospect that lives in your market applies for credit anywhere, an inquiry is posted to one or more of these credit bureaus, right? These inquiries are categorized according to the type of loan that member is seeking. Most of them are loans. There are certain types of insurance potentially that are categorized by the bureaus as well. We then cross-reference your database daily with those inquiries to generate leads. We further qualify those leads, again, based on your criteria for those types of loans that you're looking for, and then respond with a firm offer of credit immediately upon receiving that lead. And we send those leads to you as well. So you have the ability to select which categories of inquiries you want to target. So mortgages, auto loans, credit cards, installment loans. We pre-screen those leads again based on your qualification criteria for each of those types of leads. And we receive these alerts daily from Equifax, TransUnion, and Experian. So we provide these lists to you each day, each morning, basically before you come into the office. You'll get an email from us with a link to download your list of that day's leads. And we would send out any direct mail or email offers that same day that we send you those leads. So now you have a list of leads of people that are actively seeking a loan at another financial institution that meet your credit criteria, that your loan staff can contact via phone or personal email. And you'll also know that we'll be sending out a letter and or an email to them as well. The same day we identify that lead. So it's within a business day of them obviously applying with another institution. Cost for credit alerting is different than the cost for credit prospecting. It's based on the number of people that we're screening each month. So what we can do there is actually run what we call an opportunity analysis, where we'll review how many people, how many of your members or customers in the past month have actually been in the market, have had a hard credit inquiry for a mortgage loan, an auto loan, or a credit card, and how many of those meet your credit criteria for those types of loans. And that type of report will look something like this. So as an example, this example is based on looking at 20,000 individuals. And we'll assume, I'll get back to what this means, but we'll assume a contact rate of 35%. So I'll explain what that means. And a fulfillment cost of $2. So we're going to make an outbound phone call and send a direct mail piece to anybody that's actually actively looking for a loan. And we're going to assume that that costs $2. So when we look at the different types of loans, mortgages, autos, and credit cards, what we see typically in a given month is that about 1.5% of your account holders are going to be in the market for a mortgage each month, a little over 1% for an auto, and about 0.5% for a credit card. So when I take these percentages times those 20,000 individuals, what that means is I'm going to find about 300 leads for mortgages each month, about 212 for autos, and about 106 for credit cards. Now, when I send out letters and when I make phone calls, I'm not going to reach everybody. Some people are going to throw out my letters. I'm not going to reach everybody by phone because I'm going to be calling people at home when they're, at work, or I'm going to be calling home phone numbers instead of cell phone numbers. Some people aren't going to answer the phone, all those types of things. So that's where my contact rate of 35% comes in. I'm only going to touch or reach 35% of these leads. So meaning I'm going to have contact with 106 people on the mortgage side, 74 people on auto, and 37 on credit card. When we look across our customers with credit alerting, what we see is that we can actually close about 10%. They're closing about 10% of the mortgage leads, about 12% of the auto, and about 8% of the credit card. So they're generating, of these 106 mortgage leads, they're generating about 11 mortgage loans, about 9 auto loans, and about 3 credit cards. And if you look at the bottom of this slide, we're estimating mortgage revenue at about $2,330 per loan, and that's based on a $100,000 average mortgage loan at a 2.3% margin. Hopefully that margin's growing, but that's what we're seeing now. Auto revenue is coming in at about $455 per loan, and that's based on an average of a $26,000 loan at a 1.75% margin. And credit card revenue is coming in at about $350 per loan, and that's based on an average balance of $7,000 at a 5% margin. So what we're seeing is these 11 mortgage loans are generating $25,000 in revenue, $4,100 in revenue on the auto side, and $1,000 in revenue on the credit card side. The credit data cost for monitoring 20,000 account holders is $1,600 per month. And then if I take this $2 in fulfillment cost times my 600, times my 620 leads, that equates to $1,240. I add that to my $1,600 in data cost. That gives me my $2,840 in total cost for the campaign. So that's this column here, showing me my revenue per dollar spent is that I'm generating $10.84 in revenue for every dollar that I spend in the campaign. So this is the type of analysis that we can perform to determine if credit alerting would even make sense potentially for you. And then from there, if it makes sense, we can, discuss the details and determine if you may want to proceed with this type of program or not. So credit alerting isn't right for everybody. It definitely requires, some work and follow-up. If you're not prepared to do the follow-up as far as some phone calls, then it may not be certainly appropriate. It's not appropriate for small institutions. We typically see that you have to have at least 10,000, account holders really to make it worthwhile, typically as well. Credit prospecting, however, is definitely appropriate for financial institutions of all sizes. And that's the information I prepared for you guys today. So I didn't see any questions pop in during the presentation, but like I said, I'm certainly available to stay on the phone a little while longer and answer any questions that you may have. Feel free to type them in to the GoToWebinar toolbar. And I'll be happy to answer them, or feel free to contact me offline, and I'll be happy to answer any specific questions, relating to your specific situation, or get you any pricing or counts for campaigns that you're considering. So, again, I appreciate your time. Thank you very much for joining us today, and I hope the information was valuable.